Perfect. Good morning, everybody, and welcome to Mortar and Margins. And today we're going to be talking about, apart from anything else, the death of London, as it's being called in the media. Or is it the death of London, or is it a bit of a classic media storm where they've kind of missed the boat a bit? Stick with us and you'll find out what we've got to say.
So, Adam, it seems I'm very slow today, and I just missed the sting and I messed up the beginning. So hopefully I'm going to wake up in the course of this podcast. But here I am down in London in a house on the edge of London, which I might want to sell this year. What's your message to me?
Well, selling at the moment isn't the best. If you don't have to, I probably wouldn't. But what we've got is headlines that are saying London is dead, this is the end of London, blah, blah, blah. It gave me a wry smile, to say the least, Duncan, to be honest with you, because in 2015, when I was just a mere whippersnapper, and, well, I'm not sure about that in age terms, but certainly in property market experience terms, I was, as usual, upsetting people on social media without meaning to by saying that the London market was in trouble. If you think back to those times, the market was up 30-40% over the course of a few years. Everybody wanted to invest in London. It was all 2-year mortgages, rip it all back out, go again, capital growth is king, blah, blah, blah. And what had really happened, and this is why I was very convinced of my position at the time, is that over £100 billion of money from outside of the UK had come into London. It had come from all sorts of different sources, right? So we'd seen money from Russia, granted, but we'd seen money from all over the world, America, Canada, everywhere you can think of, really. And it didn't need leverage. So traditionally, it's been difficult when people have moved to the UK to buy property. Certainly takes sort of 12 plus months, back then maybe 2 years or more, to build a credit file to be able to get a mortgage. But when cash comes in and cash transacts, then the mortgage market, the FCA, the PRA, all the rest of it, they don't really have a lot of influence on that. And that led to certainly 2014, what you see in the top of every market that you see in property, sealed bids for stuff going way, way above asking price and things like that. And to me, it was very clear the writing was on the wall that when the pace stopped, of course, 2014 is now considered the top for London Prime, and Prime has done very, very badly over those past nearly 12 years now. It was very obvious it was the top, and that was not a sustainable level of growth. But instead, I had people telling me off left, right and centre. I didn't know what I was talking about. And you scurry off and invest in Stoke, which in that past decade, not that I'm bitter in any way, shape or form, has done far, far better than London property has. But as I say, it was just the old mathematics. Now what we've got, which is another classic that repeats itself in all these sorts of cycles, is the press catching up 10 years later than all this has happened. And it's just a bit silly. If you think about it, and of course I do from a macroeconomic perspective, when the budget in 2024 was announced, Rachel Reeves had this lovely graph that she showed briefly. You don't show many graphs even when you're the Chancellor, because people don't like them that much. But what it very simply showed was that they were going to support the bottom 10% more than they felt the bottom 10% had been supported over the Tory administration, and the top 10% were going to pay for it. Right, so if you are lucky enough to be in the top 10%, then you were going to get taxed more. Your assets were going to hit harder. Now, what do we know about London, the vastly outsized economic centre of the UK? Right, it's unusual by international standards in how much more dominant London is than Birmingham and Manchester in the UK. Right, very unusual. So guess what? Where do the top 10% of economic activity go on? Well, it's in London. So we would be expecting things to be suffering. Now, if we were sponsored by one of these wonderful offshore relocation firms, Duncan, I'm sure we'd be saying it's just because everybody's going to Dubai or whatever.
And they can contact us in the comments if they do want to sponsor the show.
We're happy to talk, although our principles come first, Duncan, of course, as always, depending on how big the check is, I suppose. Yeah, sure. But ultimately, that's a more ideological spin to put on it, isn't it, realistically? We're taking more out of the tax system. The government is taking more out of the tax system. It's being a bit more redistributive than the last ones. Who's going to be hurt by that? London. who was hurt in the budget realistically? And we haven't seen a huge sort of, and I suppose it's because it's the old Daily Telegraph story of, I earn £286,000 a year and I can't afford to send Tarquin to private school or whatever, that nobody, one of those meme style headlines that you get in the Telegraph sometimes.
I seem to recall that one being a fake as well, Adam.
Yeah, I think so. Yeah. The mansion tax obviously hits London drastically disproportionately, because you really have to go some way around lots and lots of the country, find a house that would be worth £2 million. In London, you can find a flat quite easily that's worth £2 million, and certainly flats that are, well, they're probably called apartments at that level, that are worth £8 million for the top level of mansion tax. So London is being disproportionately affected by, remember the first rhetoric that Mr. Starmer used, those with the broadest shoulders bearing the burden, Duncan. And ultimately that has slightly depressed the economic activity. It's depressed people's outlook, housing, house prices. They're also about optimism or the lack thereof. So I think at the moment, if you were looking to sell, you'd probably be selling somewhere near the bottom. Now, if you're moving to somewhere nice and leafy in the southeast, you might get a commensurate discount for that. So it wouldn't necessarily be the worst idea in the world. But from an investment point of view, there's a real case here that it could be argued to put money into London. The problem with that investment case at the moment is that the yield is not really there. And one thing I've never liked about the London investment market to hold property is that I have always had concerns over affordability growth, because so many rents are so close to that affordability ceiling at this point in time. If you haven't got rental growth, it makes things much more difficult. And I've always looked for rental growth in what I'm doing, ideally above the market rate, above inflation if possible. And I don't necessarily see that in London, because the frozen tax thresholds start to mess with people's disposable income. We saw a drop in disposable income in the first 3 quarters of 2025 of 1.7% for households. There's only so many ways it can go around, aren't there?
Right. So in your answer there, Adam, you managed to do down my profession by saying we're 10 years slow. You've managed to talk down my house price, I think, as well. But I did get that what you were saying was actually that you think that this situation where prices have been falling in terms of the property values might change just because of where we are in the cycle. But you still don't think as a property investor that makes it a good move if you're looking to, let's say, bring some income out of those properties through rents, because there's just no room for those to grow. That's right.
That's right. So if interest rate is 6% and the yield in London is 5%, where's the investment case for holding property? You could do if you thought it was going to grow at 10% a year. I'm not saying that's going to happen. So it does make it more difficult. But if you felt at the moment lots of deals out there, because according to the press, there's blood on the streets, well, if you were making a big discount on the way in, your running yields might enable you to be holding stuff in London. And that would, I'm sure there'll be people who listen to this who are doing exactly that at the moment, because they don't want to come and invest in the Midlands or the North or whatever.
And are there other places in the UK that look like London? Is London truly unique, or are there other cities, other towns where you see, a similar propensity for prices maybe to rise because of particular buying habits maybe coming in?
Well, it's a great question. I think it is unique because it gets segmented in so many ways. But then we've done exactly what I sometimes dislike and just talk about London as a whole, whereas really segmented to prime, inner, outer. There's much more segmentation you can do. There are definitely boroughs of London you could look at. If you do segment the data and look in reports like the Rightmove report, they distinguish between all the boroughs of London. And what took a hammering last year actually was Westminster, Camden, Kensington and Chelsea. Right. So the very, now these are obviously boroughs where the average property is 7 figures and sometimes up to sort of 1.6, 1.8 million. And their asking prices drop 10%. So sometimes there's also the disproportionate nature of the very top end of the market where people aren't buying. And apart from anything else, the other thing not mentioned is stamp duty's a killer, right? An absolute killer. So you really need to be very sure to be buying and selling houses at that level when there are all these extra tax demands on your money and your wealth at this point in time. So people who are in London can often afford to stay put. And so what you actually see is you see a flat market, maybe it's dropping 1 or 2% or something like that, but it's the transaction volumes that you see drop. If you tried to apply the London logic to, let's say, Manchester, for example, is there prime Manchester? Yeah, sure there is, but not to the extent where you've got analysts who are reporting on it and talking about it in that way, like it's its own segment of the market. And it's probably more a few entrepreneurs and a few footballers and associated people who make up prime Manchester. Whereas in London, much more likely to be hedge fund managers, etc., with really, really outsized net wealth. That means that the percentage of their net worth they're spending on a house is actually quite small.
Yeah, and 2 decades of government effort to sort of rebalance the country. I mean, you pointed out this sort of exceptionalism that London has, and people often hate talking about it. I mean, I kind of hated the way that in the media we would always talk about London, because so much of, the newspapers, the television channels were always based in London, and there's been a big effort to sort of fix that over the last 20 years. But it really hasn't, I think, changed a lot in terms of the fundamentals, because there still is this attraction, and it's an international thing, isn't it? I mean, people looking from around the world, they see London and they think England, right? And
yeah. Manchester's on the map because of Manchester United. Yeah, sure thing. That is the reality of it. But yeah, levelling up wise, I mean, look, per capita, it's widely known that London is the least spent on, right? The difficulty has been, as it often is, the way that the Treasury Green Book and Blue Book work, whether to put, it's very easy to make a business case for putting money into infrastructure in London, because you're going to move so many more people who need to be moved from, for example, Reading on Crossrail. And then, of course, you're going to screw the project up, and it's going to take much longer, and it's going to cost much more than you thought it was going to do. But at the end of it, you've done something much more meaningful. Try and make that case for east to west rail in the north of the country, which definitely needs sorting out, or road for that matter, which definitely needs sorting out. And the fact that there's fewer people around, it makes it more problematic. And the way they do the calculations doesn't favour things. So I think things have levelled up to an extent. But if you haven't got the tax coming in and you haven't got the growth centre coming in, I mean, if London ever decided they wanted Lexit or whatever and they were going to leave the UK would be in a lot of trouble, Duncan. It's just economic fact. So it's highly productive, and it has all the good points of being highly productive, and it has all the bad points of being highly productive as well.
And just in a short answer, Adam, so you said, you wouldn't look to come to London right now. If you had to name one place where you would say, this is a really interesting place for me, if I were, if I had to just go to one place to look in the UK, where would you be looking?
So I'd look at the northeast, right? But I'd selectively look at the northeast. I don't mean just go there and say, oh, that's in the northeast, that must be good, because there's some big regeneration projects going on. So if I picked a place to look at, I'd say Middlesbrough and the surrounds.
Excellent. Good, simple answer. Thanks. Right, Adam. So we're going to have a look at another story now, which is this one coming out of the US. And this is the latest housing story to come out of the Trump administration. So, we were talking yesterday about what we should discuss today, and you said, the purchase of mortgage-backed securities to, in an attempt to sort of bring mortgage rates down. Last week, we were talking about limits on credit cards and the ban on institutional investors buying single-family properties. And this, this housing affordability is a massive political issue in the US, probably even more than here, I would argue. And Trump's determined to do something about it, right?
I think you're definitely correct that it's a bigger issue over there. And if you look at the way house prices have moved in the US versus the UK, we've had a big adjustment in real terms after inflation since 2022. Liz Truss, etc., have sort of sparked all that off. So whilst house prices haven't fallen, they've gone down maybe 15% after inflation. That's not happened in the US, right? We've seen a huge I mean, on the longer term amplitudes, the US market looks badly overpriced without looking too closely. Then you start to peel back the onion and see what's going on. And of course, they've economic growth, significant economic growth as well, which can fuel a housing market as well. But this is really interesting. And this is classic Trump. I fancy doing something. I'm going to go about it in a whole multitude of different ways. And I'm either going to get actual results, which I'd quite like, of course, or brilliant sound bites and look like I'm, in this case, a man of the people. And I do think that at the core of this, he really does want to help the average American get on the housing ladder. Now, pouring petrol on a fire, if the US housing market is in a bubble, is perhaps not overly helpful. But the number one predictor, and a lot of people don't know this, by some way, the number one predictor of how house prices are going to develop is the availability and the price of credit, right? So when you have a credit expansion, which effectively this would be, so we can get deposits from other places. So how do you expand credit? You either lend on bigger multiples of income, you lend to people with no income, no job, etc., etc. We know what happened when that one happened. You lend to people who can self-certify their figures. That doesn't work out so well either, right? Or you let them get more money from places. That place is either banks in those situations, or if they've got it themselves in pensions, then that bridges the gap of the deposit. So for what it's worth, I think a lot of the rhetoric and the data's pretty weak, certainly in the UK, around how much of a blocker or not the deposit is to first-time buyers. But what we do know is if people can find it and borrow it, they will use it on buying houses, because first-time buyers are highly motivated, Duncan. They want to get on the ladder, and they'll do whatever it takes to do that. So it does look like, again, quite a thoughtful move, actually, that will certainly move the needle in terms of how many people can transact. Will it have a damaging impact on prices in the medium term when they're arguably already overvalued? Perhaps it will.
Yeah, I mean, the argument is, isn't it, that if this increase in prices is to do with limited supply and constraints on supply, then increasing demand by making it easier for people to borrow is only going to push up the prices even further, and you create a kind of vicious spiral there, which is, you know, how.
Yeah, I think the thing is, you've got to think markets are, you know, this is the Trump way. There's interference of the highest order that seems to be, you know, par for the course these days, not just in America, but also in the UK. So if you're going to mess with markets, you might have outcomes that aren't the best for everybody participating in those markets. So they do need to be quite cautious on that front, I think. But it seems that it's the free market until we don't want the free market, and then we won't have a free market. Seems to be the way forward. We've lost your audio, Duncan, I'm afraid. So I don't know whether your mic battery has run out or something like that. But let me just say a little bit more about the 401ks and all the rest of it. So for those who don't understand, it's the US version of a pension, and they're much, much more likely to be invested in the stock market than we are in the UK. So this is why the American economy takes so much more attention, or that the public takes so much more attention of the stock market. It really controls a lot of people's net worth, and they can have quite a lot of money in these 401k accounts, and they're watching the stock market go up and down, and they're mad. This is why people like Jim Cramer on his famous Money show, famously one of the worst forecasters of all time. So please don't follow his stock tips apart from anything else. In fact, the inverse Cramer is a popular fund choice, or at least a bit of banter anyway in the city.
But Adam, so I think you preempted my question there. I was going to ask you about this policy is about using retirement savings, potentially dipping into your pension, taking some of that pension out, putting it into a house. And this has been, I think this has been a kind of very popular philosophy of, you know, my house is my pension. I don't necessarily need such a big pension because I'm going to put the money into my property. And, you know, I think they are saying they want to make sure that this doesn't reduce people's pensions, and they're going to announce some kind of magic mechanism for that. But in general, what do you feel about that? Do you feel this is a sensible approach for people to be taking, to say, you know, I want to be having property as pension? Does that work?
Well, if we go back to some of the arguments that I used in the London section, Duncan, what's often forgotten, the US stock market has done exceptionally well over the past decade or so. Before that, for about 12, 13 years, it did very, very ordinarily indeed. Now, that's largely stock market cycles. You know, it can go down 10% in a year quite easily. It can go up 25% in a year quite easily. It does well over time and averages about 7 or 8%, perhaps 9 in the US over the last 150 years. So inflation beating, however you look at that sort of level of return, but there's volatility. So this is where normally people smooth this out over their lifetime by, as they get more towards retirement age, they have fewer equities and they have more in bonds, which aren't as volatile until they are volatile, like they have been over the past few years. And they're certainly volatile when Mr. Trump comes in and says, right, we're going to buy $200 billion worth of these ones and things like that. But volatility is badly misunderstood broadly in investment as a rule, certainly in the retail investor's mind. And safe returns, and property has largely been safe returns, as long as we're talking about, remember in the US, they use 30-year mortgages as a rule, and they're actually expanding to 35 and 40-year mortgages, probably at a bad time because the yield curve is getting steeper as they get up there, but they need to make the numbers work. But over 40 years, if you're investing in a nice low volatility asset like property, should be fine. What they could really do with doing is making more of their mortgages portable so people can move a bit more. But the US, like lots of countries, has reasonably high frictional costs of moving. There's high emotional, mental capacity costs of moving apart from anything else. So it moves perhaps less than it should do. But I totally agree with you. Your supply side point is a good one. They have a zoning system. They deliberately restrict over there, just like we do. They have much more land, and it's easier to construct because they use obviously different weather apart from anything else. So not that easy if you need to be tornado proof and all the rest of it in some parts of the States or whatever. But they use timber and they whack these walls up very, very quickly. It's quite modular. It's constructed in a very short space of time, and land is nowhere near at the premium that it is, although some of the most expensive land is in New York and LA, of course.
Of course, it's not one place, like London's not one place.
No. It's a huge patchwork indeed. It's huge patchwork.
So just to finish on that, you would say this is a good move. You would, if you were Donald Trump, you'd be doing the same. I mean, obviously politically, I think you think it's a positive move, but in terms of, is it a good move for people who might be wanting to buy a house?
Well, for the people now who want to buy a house, yes. For the people in 10 years' time who want to buy a house, probably not, is the reality of it. But of course, politics works to a short cycle, doesn't it? Especially in the US, an even shorter cycle than it does in the UK, which is not a good thing, let's face it.
Yeah. Although, to be honest, I wouldn't take any bets about Trump not being in power in 10 years' time. So he has to take a longer view than maybe.
I was just thinking exactly the same. Yeah.
Great to talk to you today, Adam. Back again next week, same time, 8 a.m. Again, anything you want to leave in the comments, please do. I'm just going to have a quick look through now here. We do actually have some comments, Adam. We should probably take this. Some endorsement of your views on Tyneside because of the free ports there. And then the question: if the credit expansion helps free up the people stuck not being able to move, it may help stock levels. It may help stock levels and slow down the pressure. So, yes, I
don't know how that works without thinking about the supply side of things. Look, I mean, there's an argument there which we should probably just briefly go into around, and this is one of the UK stats that isn't bandied around very much. How many spare bedrooms there are in an evening in the UK when you've got people who are homeless, and there's over 10 million spare bedrooms that are being unused every night in the United Kingdom. But I think in reality, the older you get, the stickier you get in your property, and the less you want to move and go through that emotional side. People often say, like, have a stamp duty holiday and people will move a lot. But there's a lot of other motivators that go on once the Englishman's home is his castle and blah, blah, blah. If there's not new stock being built, then how does freeing up transactions really help? Look, a stagnant housing market does not help the economy, right? Because people who could move from Chicago to Denver don't move. Yeah, that's definitely true. If they can't port their mortgage and or the transaction costs are too high, that's definitely inefficient. That impacts productivity, but unless you sort out supply, then you're not going to address the long-term problem. Unless the population starts to fall because you don't have any migration, because everyone's so worried about going there, and you're chucking people out left, right, and centre with various tactics that are probably frowned upon by most people.
Yeah, I mean, that's a good topic actually, isn't it? Because that's something we're seeing here in the UK as well. We're seeing this suggestion that we may actually have a net exodus from the country at some point, because if we stop immigration, people are actually often still leaving, and that could change quite a lot. I think the dynamics of the property over time, but obviously it's a slow and quite a gradual change. Anyway,
You
again,
would think so, but we've been undersupplied for 15 years at least, and more like 20 years realistically. So we still have to go quite a long way until the net exodus sorted things out. And you do also have to look at one of the biggest factors over the last 50 years plus is that the number of people per household is falling. So actually, you could argue it's not really a supply problem in the UK; it's the number of people per house that's used.
Real problem. Yeah.
Yeah.
I don't necessarily see that changing, especially people having fewer children. I think it's almost the numbers per house may continue to fall. Anyway, great to talk to everybody. Thanks for joining us. Next week, 8 a.m. we'll be here.
Thanks for your comments, everyone.